And what markets typically tend to do is they tend to retrace to internal range liquidity prior to targeting external range liquidity again. And this gives us a trend. So as the market is going lower, right, it's creating lower highs and lower lows, but as it's taking out external range liquidity, it might retrace back into internal range liquidity, right, create a lower high somewhere inside of this range, this newly created range, and then it continues going lower. So the internal range is being created on the retracements as the market continues to drift higher or lower. And typically what I like to do is position myself inside of internal range liquidity, targeting external range liquidity. Some traders, and this is specifically speaking for counter trend traders, they like to take the external range liquidity to trade back into internal range liquidity. Now, yes, you can do that, but it is much more difficult to try and do because you don't know exactly where inside of the internal range the market is going to stop or target. So what is an easy way of determining what is external range liquidity versus internal range liquidity? And I'm just going to cover one different time frame, and let's just say we're going to go over a weekly time frame. So let's just say that this is the weekly high and this is the weekly low. And this, let's just say that this is the previous week. So last week, right? So we have last week's high and last week's low. Well, if it's trading inside, you know, let's say if we print the weekly low, anything in here, right, as we're trading, if we have not yet broken the prior week's lower high, okay, we are inside internal range liquidity. So in this example, we are trading within the previous week's range. And if we have a specific bias in mind, let's say we're trying to target the weekly low, we're going to be targeting the previous week's low as external range liquidity. So this previous weekly low may become our external range liquidity target. And this retracement inside of the internal range is allowing us to position ourselves if we are bearish biased and expecting the prior week's low to be ran out. So what we're trying to do is position ourselves somewhere in here with a target of creating a lower low at some point in the market.